What's up YouTube? Welcome back to some more finance stuff. In this video, I'm actually not going to be talking about the stuff that I usually talk about, such as how to land internships, how to network, how to prepare for interviews or interview tips. I'm actually going to be talking about my experience with options trading and why any beginner who's looking to get into it should be extremely careful and definitely watch this video to the end before you trade options. In this video, I'm going to be laying out the top 3 reasons why you should really reconsider trading options if you do want to get into trading. Let me just preface this by saying one thing. The richest people in the world got there by providing tons of value to the marketplace. They've built companies, they've changed the world for the better, and the society has then rewarded them with the riches because of how much value they've provided. If you're trying to get rich with options trading or any kind of trading that you just discovered, you saw some strategy in a YouTube short that showed you that, hey, you could risk, $100 to make $1,000 in this scalping strategy or something of that sort, I just want you guys to realize that whenever there's ways to make quick money, there's also ways to lose money very, very quickly. That's exactly what happened to me, and I want to tell you guys 3 reasons that options trading can be very dangerous if you don't know exactly what you're doing. The first reason is just due to the sheer complexity of options. Options are not just like your typical stock where if you buy it and you can just hold it, and if it goes up, it goes up. If not, you could just keep holding it, and eventually in the long run, sometime in the future, it's got to go up because it's a good company, it has good fundamentals and stuff like that. Options are not like that. There's 5 components to an options price. These are usually known as the Greeks. I'm going to explain all these to you in plain English. The first Greek I want to talk about is delta. The delta of an option simply just means for every dollar move in the underlying price, how much does the option move? So for example, if Apple moves $1, an option with a delta of 40 will move by $40. Next is gamma. Gamma is how quickly does delta change for every dollar move in the underlying stock. So as opposed to that earlier example, if you have Apple and it moves up by $1 and it has a gamma of 2, that means for every dollar that Apple moves up, the delta goes up by 2. So Apple moves up $1, the delta is not just 40 now, it's 42. It's a little more complicated than that, but that's essentially what gamma does. Next, there's theta, and this is one of the most important aspects of options. Theta is time decay. Every options contract has an expiration date, which means you only have a limited amount of time before your anticipated move of that stock has to happen. So let's say you're holding an option that expires next month. If the stock doesn't move next month, your option is going to expire worthless, and you're going to lose 100% of whatever you paid for that option. As opposed to if you just bought a stock, eventually, unless the company completely goes bankrupt, you're not going to lose 100% of what you paid. Theta is for every day that goes by, how much is the option losing in value. So for example, if it has a theta of 20, then that means in one day your option is going to lose $20 in value. Next is Vega. This is also a very important one. Vega is how much is your options price going to change based on the change in the stock's implied volatility. Most people don't understand that volatility is one of the most important aspects of options. Most retail traders, including myself, used to look at options as just ways to make directional bets. Buy calls if you think it's going to go up, buy puts if you think it's going to go down. But actually, the way institutions, now that I've come to learn how they use the options, is use them as tools for pricing volatility. So Vega is one of the most important factors, and one of the most common ways that institutions arbitrage with options is by capturing mispricing of volatility. Not simply looking at Apple and thinking that it's going to go up and buying calls. The last Greek is rho, which is how much does an options price change for a change in interest rates. This doesn't really apply to equity options, it really only applies to FX options. But now that you know there's all these factors affecting the price of an option, you come to understand how complex it is, and you might only be considering one of these factors when you put on a trade, especially when you're day trading. You're not even taking into account any of this. You're simply hoping that, if you see a bullish trend and you buy a call option, you're just hoping that the stock will go up. But there's so many different things that cause a stock to go up or down, including stuff like options. That's right, recently I've learned that actually options also influence the price of a stock, which I had no idea about. So because of all this complexity, when you trade stuff that you don't understand, even if you're right about the direction of your bet, you may be completely wrong in terms of what the volatility is. Perfect example of this is when people buy call options before earnings events. A perfect example of this. Nvidia just reported earnings last week, and the volatility of those short-term options expiring that Friday was through the roof. It was over 150, where usually the IV of that stock is around 60 or 70. Now let's say that you were expecting that the price of Nvidia was going to go down because they were going to have a bad earnings event. Let's say you bought it right before they reported earnings on that day. I think they reported on Wednesday. Let's say you bought it on Wednesday, and Thursday you see that, okay, the stock is down a little bit, but for some reason your option lost a lot of value. That's because the IV wasn't as high as people thought it was going to be. The realized volatility of that option wasn't as high as the implied volatility before that event. So if you don't understand something like this, you're gonna be right about the direction but still blow up your account, because you're gonna wonder why it is that your option lost value even the price is going down. Second thing I want to talk about is how fast options move in value. This applies more to day trading, and I want to just share a little bit of my anecdote here. I was trading SPX options. Now, if you don't know, SPX is the index of the S&P 500. It's around 6,000. That's the price of it. And the delta on these SPX options is around 50. So that means for every dollar that SPX moves, the option gains or loses $50. And SPX, because its size is around 6,000, in a matter of minutes, it could move $5, $10. And that means in a matter of minutes, you could make 500, $1,000 or lose 500, $1,000 just trading one contract. What happens, especially when you're trying to day trade and you're trading with a lot of frequency, is as soon as a position goes against you, you'll start getting emotional, and if you know a poker reference, you'll start going on tilt. Especially that's what happened to me. And I just want to preface this by saying, you might be watching this right now and thinking, I'm not like that. I'm way more emotionally stable. I can control my emotions better. And I just want to tell you guys that before I did this, I thought the same thing. I thought I was extremely mentally resilient. I have very good habits throughout my life. I thought I had very good discipline throughout my life, and I thought that would correlate to trading as well. I thought I'd be very disciplined, manage risk well, but that's not the case. In the heat of the moment, when the tilt kicks in a matter of minutes, you'll start trading the opposite of what you should have been trading. So an example I'll give you is, I have some indicators that tell me when to start a scalp and just catch a move up or down just for a few minutes and make a lot of money that way. And sometimes it worked, but the times when I had days where it was just horrendous was the days when I would have one losing trade and not even lose that much, but then I would start thinking that, okay, because I'm wrong, maybe if I take the other side of this trade, I can recover my loss. Right? As human beings, we're very loss averse. We don't want to take a loss. And so then you take the other side of that trade, and now what'll happen is it'll actually go up instead of go down. And then you'll say, wait, it's going up. I thought it was going to go down. Okay, well, let me try to trade the up now, and then it'll go down. And you'll just keep spiraling and putting on trades, and at one point you'll just abandon your edge, and you won't realize why you're doing what you're doing unless you're down like $1,000 and you're like, whoa, hold on. What just happened? 5 minutes ago, I was down $100 because I made a bad entry. Now all of a sudden I'm down $1,200. Like, how did that happen? Right? So that's the other reason why, especially if you're trying to day trade, which I highly recommend against, just know that options move so fast, especially on high volatility stocks like Tesla or Nvidia, any of the tech stocks, or any of the indices. For every dollar in move, if it moves $50, which is around what all these tech stocks have as a delta, then you got to realize that in a matter of minutes, you could be down hundreds or even thousands of dollars. So don't let that potential upside fool you, because the potential downside is just as much. The last thing I want to talk about is the emotional toll of day trading and how it can borderline become gambling. I saw this one video once that told me that in order to get started in trading, you need to have a certain level of greed. The only reason one would trade is to make money. Now, opposite of, whether you're trying to start a business, whether you're trying to buy real estate, whether you're trying to invest for the long term, those are all different reasons of why you would do such a thing. Maybe you want to build a business because you want to get rich, but you also want to provide value, and that's how you'll get rich. You want to buy real estate because you want to invest for the long term. You want to accumulate wealth, which isn't greed. Greed is very much short term. I want to make money fast. I want to get rich tomorrow. And the video talked about this is why most people get into trading. And when I was getting into trading, I had fooled myself into thinking, no, I don't want to do this because I want to make tons of money. I just want to learn from it. Because I have an internship going into sales and trading, I want to learn risk management. And the way I'm trading now is way more relevant to the type of things I'm going to be doing on a trading floor, such as managing risk and trying to arbitrage volatility, not using thousands of dollars, but maybe risking $60 a trade. It's a much better way to do those things that I initially set out to do, instead of what I was doing was just trying to day trade and scalp and make tons of money. Because there were days where I had made $1,000 in a matter of minutes, and it was crazy to me. I saw that I traded one contract in a matter of 10 minutes. I'd made $1,000 because SPX had moved 10 points. And I thought to myself, well, hey, I don't need a job. If I can make this kind of money on a daily basis, especially if I scale up, what if I was trading 5 contracts? What if I was trading 10 contracts? Now keep in mind that the reason I wanted to trade was not to make fast money. That was not what I set out to do. But seeing that green number in such a fast manner, your mind can't help but wander to those places. You start fantasizing about the what ifs, and you start thinking about stuff like what are you gonna buy once you've made so much money. And that is exactly what will cause you to take on more risk. That was exactly what caused me to start trading 2 contracts, 3 contracts. And it took a day where I had this same emotional high frequency trading where you don't want to lose money. So you take other side of the trade, and then the other side of the trade, and then the other side of the trade. And before you know it, you're down a lot of money, to realize that, what am I doing here? I'm not managing risk at all. I'm not sticking to any kind of principles. What I was doing was gambling. And without even realizing it, I was close to developing a gambling addiction because, after 3 losing trades, a disciplined trader would say, hey, I'm not thinking straight. I should stop. And I should reassess, and then maybe I could get back into it when I'm thinking straight. But no, a gambler would go, wait, I'm down a lot of money, but I got to get back to even. That's the thing that really destroys your trading, is just that mindset of I got to get back to even, especially when day trading. I'm talking about day trading. And it'll cause you to do things that you just never would if you had a straight, clean mind to begin with. Once you've had a few losing trades, the tilt that sets in so quick, and without you even realizing it, you'll tell yourself, I'm calm, I'm going to make a good decision, but you're really not. You can tell yourself all you want, but you're really not. And some of you might be watching this saying, well, this kid is just stupid. He's a stupid 20-year-old kid, got into options, started gambling. And that's exactly right. That's exactly what I did. I was a stupid kid who got into options and got roped into how quickly you can make money. That's why I'm saying the same thing can happen to you as well. Like I'm saying, before I got started, I was not at all intending for this to make me rich. But as soon as I saw some fast money, I couldn't help but get attracted towards that fast riches. And it happened so deceptively. I didn't even realize it was happening. And You might tell yourself that, I'm much more mentally strong than this kid, and, good luck to you. I just want to tell you, I thought the same thing. I thought I was very mentally strong, very disciplined, because I am in most aspects of my life. But when you see those numbers, when you see the fast money, I'm telling you, it will rope you in, and you won't even realize that you've been roped in. You'll take more risk, and you'll lose a lot of money. Now, after all of that, I do want to say that, trading is a very good way, especially if you're in college, to show that you have interest in the markets, that you want to learn technical knowledge about different market things like options, maybe futures, you want to trade futures. Just make sure that you're not risking a lot of money. Start with an account of like 500 bucks. It won't allow you to day trade, which is good. There's a rule, the pattern day trading rule, which means if you have anything less than $25,000 in account value, it won't allow you to day trade. If you do day trade, it will close down your account and it won't allow you to trade. Start with really, really small amounts of money and learn a lot about what it is that you're trying to trade. For example, options. I spent almost a couple months learning the very in-depth things of options, like as all the Greeks, different strategies to arbitrage volatility, which is what institutions actually do. They use options as tools of volatility, not just directional bets. Don't risk more than 50 or 60 bucks a trade, because you should treat your account like money that you're just investing into education. That way, when you lose a trade, even if you lose 5 trades and you're down half your account value within the span of a few months, you're not going to stress too much about it, because the emotional toll of day trading, the emotional toll of losing thousands every single day there's nothing like it. I wouldn't recommend it to anybody. So I definitely do encourage trading, even options trading, but I definitely want you guys to learn a lot about it before you get into it. And please, please, for the love of God, do not day trade. I know there's going to be so many people that disagree with this, so many successful traders that have edges, but you got to realize that, that stuff might even take years to develop. And if you're willing to lose thousands before you've actually developed that edge, then go for it. But I just wouldn't recommend it. I just want to live by the principle that money that comes in quick also has the potential to go out really, really quickly. So definitely get involved in options trading, but keep this in mind. Always keep it in the back of your mind that you should not look to get rich off of options trading. You should use it as a tool to learn more about the markets and what are the different factors that actually affect markets. So I'm going to leave you guys with that. If you completely disagree with me and think that I was a complete dumbass who doesn't know anything about what he's doing, leave a comment below. If you think that I'm full of shit telling you guys not to day trade or not to trade options, tell me. Let me know why you disagree with me. But I think a lot of people will gain a lot of insight from this, especially if you're new to options and you're just really excited to get into it. Please take a step back. Please learn a lot about them. Don't lose thousands of dollars trying to trade them quickly. So I'll catch you guys in the next video where I talk about some more finance stuff. And thanks for watching till the end. If you found any value from this or any of the other videos that I've made about how to get internships, how to prepare yourself, how to network, please do subscribe and follow me. And I'll catch you in the next video.